All right, we're back with another deal here. Disaster restoration company for sale in Virginia. Disaster restoration, remediation companies, these are all great businesses because they're very, very recession resistant. If shit hit the fan and you have a flood, you are going to call whoever you need to go, whoever you need to get that remediated. And oftentimes it's insurance based. So as long as you have a good, solid baseline company, it all works out, right? So this company, 4.3 million asking, cash flow 1.3. Obviously, have to be vetted, and I'm going to assume about a 25% discount on that as what's probably real cash flow. 2.3 in revenue. So they're basically saying it's like a 50 something percent margin. Real estate, it's not quite clear. Is this included? Yeah, not included. So real estate's an option here. So this effectively that means this guy, the guy who owns it, also owns the real estate. So there's options to be had here to either leverage real estate to get a better structure of deal or to potentially find an investor who will take that real estate and help you buy down the purchase price of this business. Let's see here. So high margin business, remains to be seen. Small workforce, pretty typical for these types of companies. It's restoration business, emergency services, fire, water damage, restoration. Yeah, so it's straight remediation business. They're always profitable, always great. I don't know what the market's like in Virginia for these, but I know Florida and California, this is big, big business, very profitable business. And it sounds like the owner doesn't really do much, probably managing people and managing schedules more than anything. That's why they say doesn't need industry expertise. It's likely based on that. The biggest one's going to be how are the relationships managed? Because, like I said, a lot of these are insurance driven. So if you don't have a good set of relationships, or if those relationships are tied to the owner, not the business, once that owner is gone, you now have a lot of issues, right? Now that said, it is pretty much everything they're saying is about true. You're probably not going to have to do any cold calling or door knocking to get business. You're probably going to have lots of repeat business because they're basically a vendor for a bunch of different companies, insurance companies, and otherwise. And it is recession resistant for sure. They're really lucrative businesses, but they don't grow massively, at least from my understanding, from what I've seen. I've seen a lot franchise out or get into multiple locations, and that's how they scale. But in one singular location, I haven't seen many that have scaled drastically. So 6-person business, very small size, which is great. They own the real estate. They're willing to lease it. That's perfect. You can structure it as part of the deal. Owner wishing to retire, all good signs. We've seen some deals from this brokerage. They're not bad at all. So pretty decent little business here. Let's take a look at the numbers and see what this breaks down to. So they're saying 2.3 revenue, 1.3 in cash flow. Like I said, I'm going to discount that by about 25% and just assume that's closer to the reality. Might be less, might also be more, it just depends. So they're asking 4.3. It's a bit high for this size of business. It just depends where the relationships are held, but it's not a bad asking if you can structure in 4 or 5 months working capital being left in the business. You'll end up having to offset by that amount in the loan size anyways. So it's not really that big a deal, and better off just meeting the price, and that way you can beat out competition. 4.4 multiple based on the discounted cash flow. And so your fees, when you break them down here, just to kind of break down due diligence fees, your legal and accounting, likely about 43 grand. It'll be less if they don't ask you to do any type of heavy duty due diligence, like a quality of earnings. But at this size of company, you may get that request depending on your lender. SBA guarantee fee is probably going to be a lot lower than this, but again, rough estimates here. Loan origination fee, again, probably going to be much, much lower, but about that. Miscellaneous closing costs relating to share purchase agreements and otherwise. It could very well be this, depends on how aggressive the owner wants to be in back and forth here, especially when you're talking working capital. Often we do find it gets up into the $10,000 or $15,000 range for really heavy back and forth negotiations, and that can go 5-6 times higher depending on the lawyer you use. If you're using a good M&A lawyer, specifically M&A lawyer, not just your random real estate dude who these costs will go down quite a bit. Then if you decide to work with someone like us, we would be a 5% and we'd just be rolled into the loan or paid off over 12 months. So this potentially could just be removed from the process. But that leaves you with an SBA loan of 3.7 million, seller finance $1 million if you're doing a 75/25, which I think is what you would need to get this past the bank. Because what I am assuming is a big chunk of this is owner salary, and you obviously have to pay yourself something. And banks will expect you're paying yourself something in addition to what the business cash flows. And so when you really account for all that, you're likely going to need to be 75/25 on this loan, so you can hit your debt service ratio minimums. So I talk about this in more of the recent videos, not so much in the earlier videos because banks change all the time. But definitely what we're seeing right now is a lot of lenders pulling back to being more conservative, wanting a 1.5 times debt service ratio or higher, not wanting to lend under that, especially when you're coming into a new industry, you don't have that background. All of those kind of concerns go out the door when you're expanding an existing business, right? If you're already in remediation like that, and you come in and just say, hey, we're buying to expand, those concerns are out the door because they'll just, if anything, they'll collateralize against your existing business, and now they have some comfort. But when you're stepping in brand new, that's going to be a big thing in the back of their mind. So you do need to make sure structure for this 1.5 or higher. And so your annual debt payments 618,000 against what we're expecting is real cash flow about 975. That leaves you with about $356,000 a year after placing a baseline salary of about 60 to 75,000, which either you can place with a general manager, give them a opportunity to earn in equity, which will offset the reason why they're only going to get paid 75 or 80 grand. Or that's more cash you put in your pocket, and now you're actually up to about 420 in terms of cash flow at the end of the year that you can play with. But not a bad deal at all. So if you're in the Virginia area and you're interested in a remediation business, this is not a bad one. Obviously, lots of things to look at. I'd say nothing here is a red flag. If anything, these things are, having real estate and wanting to sell it or wanting to lease it. Those are all green flags. Retirement's a good green flag. Small companies, kind of a yellow flag. You just got to see what type of subcontractors they work with. And then the only thing that's, an unknown that could be a red flag or could be a green flag is who owns the relationships and how are those going to get managed and transitioned. But otherwise, very good little business here.